When you picture the business of independent movies, you probably imagine the traditional path: a breakout hit at Sundance, a massive theatrical release, and a giant box office return. Distribution companies shifted their focus away from hunting for the next indie darling. For the last 15 years, they followed a different strategy entirely. Distributors quietly executed an industry-wide shopping spree, buying up tens of thousands of forgotten titles. They acquired libraries of obscure films, syndicated cooking shows, and holiday specials. This massive accumulation of obscure content followed the logic of a hidden macroeconomic force: interest rates. To understand why anyone would buy thousands of forgotten films, we have to treat them like rental properties. A single modest house generates a small, steady amount of rent each month. An older indie film operates the same way. It pulls in small, consistent trickles of revenue through ad-supported video on demand, or AVOD, 24/7 fast channels, in-flight airline entertainment, educational licensing, and international broadcast rights. This diagram shows what happens when you aggregate thousands of these titles. Those tiny individual trickles combine into a massive, predictable reservoir, often generating upwards of $5 million in pure cash flow every single year. The explosion of platforms like Tubi, Pluto TV, and Amazon Freevee accelerated this demand. These services needed an endless, bulk supply of programming to serve ads against, and library acquisitions provided the volume. Distributors treat a massive catalog of mediocre movies as a predictable, risk-mitigated financial asset. The true catalyst for this buying frenzy began after the 2008 financial crisis. Central banks like the Federal Reserve lowered interest rates to historic near-zero levels, making it extremely inexpensive to borrow money. This chart illustrates a leveraged buyout. If a library generates $10 million annually and borrowing costs 2%, buyers use the library's income to pay back the debt, pocketing the profit. Cheap borrowing drove asset values from $100 to $160 million. Not a single film in the catalog changed, only the cost of capital changed. This math triggered a frenzy. Private equity firms and media conglomerates borrowed billions to buy out their competitors and hoard catalogs rather than waiting to build them slowly. The independent film market became a debt-fueled financial bubble. Scale and volume became more important than the individual quality of the films. In 2022, surging inflation forced central banks to pivot, rapidly hiking interest rates at the fastest pace in decades. The business model collapsed. Borrowing costs shot up from 2% to 8% or higher, instantly erasing the profit margins that made these acquisitions viable. Distributors halted their acquisition strategies. They shifted from aggressive growth to survival, frantically prioritizing debt repayment over new content. The era of debt-fueled content hoarding ended, leading to a brutal correction across the entire entertainment industry. This shift has immediate consequences for filmmakers. Distributors are now fiercely selective, subjecting every potential acquisition to analytical scrutiny. A movie must now prove it can generate recurring revenue. Buyers look for international appeal, educational licensing potential, and a film's ability to perform on ad-supported platforms for years. The value of a film is now determined by its verifiable lifetime cash flow, rather than the cultural splash of its release. To survive in a high-interest rate economy, creators must treat distribution as the cold, calculated science of real estate investing.